You wake up. You check your bank app. There's a number there. You treat it like something solid. Like it exists somewhere in physical form. It doesn't. That number is a ledger entry. A record. A promise. And the system behind that promise is bigger than any government, more complex than most software, and more fragile than anyone wants to admit. Today, we're pulling it apart, from the invention of money to the digital currencies being built right now. 1. Money isn't wealth. It's agreement. Point 4. Before banks. Before Wall Street. Before stock tickers. There was barter. Barter works in a village. It fails in a civilization. If you need wheat and I need shoes, great. If not, trade stops. So humans invented something more scalable, a shared placeholder for value. Shells. Salt. Metal. Paper. Around 700 BC, Lydia minted standardized coins. China later created paper money. For centuries, paper could be exchanged for gold. Then in 1971, that link was cut. Richard Nixon ended dollar convertibility into gold. Since then, money has been backed by one thing. Trust. Today, about 90% plus of global money isn't paper. It's digital entries inside banking databases. Money works because we all behave as if it works. That's the foundation. 2. The real power. Who decides how much exists? 4. Every major economy has a central bank. Federal Reserve. Bank of England. European Central Bank. They don't serve you directly. They control the temperature of the entire economy. They do it 3 ways. 1. Interest rates. Raise them, borrowing slows. Lower them, borrowing accelerates. 2. Asset purchases, QE. They create digital reserves and buy bonds. 3. Emergency lending. When banks panic, they step in. During COVID, trillions were created digitally in months. The result? Inflation surged. Then rates were raised aggressively. Then banks started breaking. This is not accidental chaos. It's trade-offs. The economy is steered with delayed feedback. 3. Banks don't store money. They manufacture it. Point 4. When you deposit $1,000, the bank doesn't store it. It lends most of it out. When someone gets approved for a mortgage, new money is created digitally. The loan creates the deposit. Money expands when lending expands. And because banks keep only a fraction of deposits liquid, they can't survive mass withdrawals. That's why deposit insurance exists. In 2023, Silicon Valley Bank collapsed in 48 hours after $42 billion fled in one day. Modern bank runs don't require lines outside branches. They require Wi-Fi. 4. Markets, the ownership machine. 4. Stocks are ownership slices. Bonds are IOUs. The stock market is roughly tens of trillions in value. The bond market is even larger. The bond market quietly sets the cost of your mortgage. One of the oldest signals in finance is the yield curve. When it inverts, recessions often follow. Markets are forward-looking machines. They price expectations, not headlines. 5. The professional money class. 4. There are layers above regular banking. Investment banks. Hedge funds. Private equity. Venture capital. They structure IPOs. They engineer mergers. They use leverage. They short companies. They buy entire corporations with borrowed money. Sometimes they create value. Sometimes they extract it. The hedge fund model often charges 2 and 20. And despite the mystique, most underperform simple index funds over long periods. Meanwhile, venture capital runs on extreme winners. A few companies pay for dozens of failures. Different strategies. Same fuel. Other people's money. 6. The quiet giants, index funds and insurance. 4. Here's the twist. The most powerful investing strategy is boring. Low-cost index funds quietly outperform most active managers over decades. That idea was popularized by John Bogle. Even Warren Buffett recommends them for most people. Then there's insurance. Insurance companies collect premiums and invest the float, the time gap between collecting money and paying claims. That float has built empires. The most powerful institutions aren't always the loudest. 7. The part most people never see. Beyond banks is something larger, shadow banking. Private credit. Money market funds. Repo markets. Leveraged structures. It functions like banking, without the same protections. In 2008, hidden leverage inside mortgage securities triggered a cascade. Banks packaged risky loans. Rating agencies stamped them safe. Insurance contracts multiplied the exposure. When housing cracked, everything connected to it cracked. Millions lost homes. Few executives faced consequences. Leverage plus opacity plus interconnection equals fragility. 8. The next evolution, programmable money. 4. Now comes something new, central bank digital currencies. Governments are experimenting with state-issued digital money. Unlike crypto, this would be direct central bank currency in digital wallets. That means faster transfers, direct stimulus distribution, potential programmable expiration, full transaction visibility. Efficiency and control begin to merge. And if people hold money directly with central banks, commercial banking itself could change. This is not theoretical. Pilot programs already exist. Money is evolving again. 9. The big picture. All of this connects. Your paycheck, your bank, lending, bond markets, pension funds, hedge funds, central banks back to you. It's one loop. A system of incentives. A system of leverage. A system that rewards understanding. You don't need to be a hedge fund manager to benefit from it. But if you don't understand how it works, you're participating blindly. And blind participants are the most profitable kind. Closing. Money is not gold. It's not paper. It's not even digits. It's structured belief reinforced by institutions. The system is vast. It's imperfect.